Well, for our own Clash of the Titans, Sandra.
All right, Gavin, thank you very much for that. Let's go to foxbusiness.com live to see what you are chatting about right now. And Simon, I've got Simon joining me right now, but we're going to take a look at Friday's jobs report and what we might see in the markets today. Online, we're seeing that it's creating a little bit of a buzz on whether or not the markets will react positively to that number. Will the markets have a hard time interpreting it? There's a lot of chat on here. What do you think, Simon?
I think, well, the futures are showing up, right? So that's good. The Dow futures are up about 30 when last I looked. One thing we do like, and I think investors will like, that it was good, but it wasn't really, really good. If it was really, really good, I think that would prompt fears that the Fed would start raising short-term interest rates and tightening monetary policy, and that wouldn't be good for stocks. If it was much worse, then I think people would think, oh my goodness, you know, we still haven't got job growth. That's a really weak economy. So it's just, I think, in a sweet spot right now, and I think investors are going to love that.
That's a really great point, actually, Jim, because a lot of traders that I talked to last week said, hey, if this number's really good or a great surprise to the upside and that job growth is increasing rapidly, the markets might interpret that as the Fed's going to act soon.
I think it's left an interesting debate among the Fed governors, and I understand there's a meeting today on the discount rate, which the Fed surprised a number of folks in February by moving it up, I believe, a quarter of a point. I don't expect any changes, although I do expect people to be focusing on the minutes of the last meeting very carefully. But yes, I think the number came in, I guess, positive enough, but still benign enough that I think that there's a balance. I think the unemployment, the big figure is still fairly high. Therefore, I do think the continuation of low rates for a period of time will continue, and I think that'll present a bullish backdrop for stocks.
But I think, Simon, one of the big arguments here, as I'm looking through some of the chat online, is the general public isn't feeling any improvement in the job market. They still feel like a lot of people are out of work, their neighbors out of work, or they're fearing they're going to lose their job.
Well, I think there's less and less fear that people are going to lose their jobs. I think if you remember back to a year ago, which was a nightmare, I think everyone was going to work wondering whether they were going to make it through the day, you know, with their job and go home. I mean, it brings to mind the old joke. What's the definition of an optimist? Someone who irons 5 shirts on a Sunday night. So that you're gonna need them. So I think there's less of that worry. Yes, we're not feeling sort of the highly paid jobs coming back. I think that will happen shortly. I am noticing, and I wrote a column about this, I'm noticing the deterioration in service at a lot of the food establishments in this area in Midtown Manhattan, suggesting that it's hard to get help these days, or quality help anyway.
All right, so what we might be seeing might feel a little bit different. All right, Jim, Simon, thank you very much for joining us on that.
We do have an instant audit on it this morning. Simon Constable's our guest from Dow Jones Newswires, and Jim Frischling of NewOak Capital is also here. Simon, your view on the apparent decision to not pursue criminal charges in the AIG case?
That makes sense. I mean, there's always a lot of blame storming. It's like pin the blame on the donkey after every disaster, and it's almost like pin the tail on the donkey, and it's done with a blindfold.
The donkey might be the perfect use of yes. Animal in this case, but go ahead.
So I'm for letting them move on. I think the ultimate thing that should have happened is that this AIG should have been allowed to fail when it happened, and I know there's all the systemic risk arguments. I've never believed them. One thing I will say, when you start going after folks, it's difficult to know when to stop, because there is an argument to be made that maybe Elliot Spitzer should be gone after, because he's the guy who drove away the founder of the company, Maurice Greenberg, from AIG, and he kept a very tight grip on things until he left, obviously when he couldn't, and then things started to unravel. So maybe we should go after Elliot Spitzer.
Well,
you see what I'm saying, though, right?
Well, people look at this, Jim, and I guess the reaction would be, goodness, if this was the company that dragged down the whole financial system, who's responsible? If it's not Joe Cassano, is it someone at one of the ratings firms like S&P or Fitch or Moody's? Is it someone at one of the big Wall Street firms? I mean, who's going to be held accountable and responsible for all the money in my 401k plan that I lost? That's a question that someone could ask, right?
I think that would be a very good question, and the difficult answer is the blame. It's quite wide. It goes to the borrowers that overborrowed. It goes to the rating agencies that clearly put a high
AAA rating
ratings on less than AAA securities. It goes to the arranger banks. It goes to the investors who didn't do their due diligence, the insurance companies, the monolines. It's throughout.
Well, the question I had for Jim in the last hour, Simon, was if that's the case, aren't we essentially making the argument for financial reform if you're saying that, hey, we can't charge these people with criminal activity, But if you can't necessarily prosecute,
we need reform.
Stupidity, can you legislate it or regulate it?
The market should be self-policing if you let companies that screw up fail.
Right.
Right, and it is.
But don't you need different rules in place to allow that to happen in an orderly way?
You need that to happen in an orderly way. You also
just
need
have the rules of the game set, and then you can play the game if the rules are fair.
You can't have the rules of the game set. They need to move and they need to be fluid because people are paid massive amounts of money to try and get around rules, whatever they are. So you need to move those rules around. But yes, the rules of the game need to be set in such a way, not fixed, but in such a way so that if you make some bad bets with your company and the company is no longer solvent, it disappears.
Yeah, it can fail.
And with it, your job. And that's
of course,
okay.
Allow it to fail. I mean, a lot of these guys did lose their jobs, but the companies disappeared and affected, or didn't disappear, or bailed out by the government, and that's left us with the mess. And all of us holding the bag for AIG, wherein, as Simon's right, it should have been allowed to fail, but the judgment was made that it would have affected the system too much. So that means we do what to allow that to happen? What are the key components of financial reform that have to be in place so that an AIG doesn't happen again? If it's not prosecution, what is it?
Well, I mean, one of the issues is putting the derivative contracts on an exchange.
Let's know what they're trading.
So let's understand, and because I think the size of that market was so opaque that it was difficult for any regulator to understand just how much risk AIG had exposed the system to, and how, I guess, correlated AIG was to all these other financial institutions. So I think I would rank that pretty high on the
raise
list.
Their capital requirements.
And raise capital requirements.
Yeah.
And to Simon's point, I think, again, AIG's been the poster child of the crisis, and had they been allowed to fail, recognizing there was other issues attached to that, but then none of these contracts would have been paid, the company would have been bankrupt, and the contracts would have been null and void. I think there's a lot of anger about the continuation of payments.
Well, what do we do about S&P and Fitch and Moody's to make sure that AAA ratings are not put on pieces of junk?
I think there's more culpability there. I will say, though, anyone who remember the book Liar's Poker, came out in the 80s? If you've read that again, you'll see references to collateralized mortgage obligations as toxic waste. That was in the 80s when things were good in the housing market. So how come everybody forgot this last decade that they were toxic waste? It's very strange to me. I think there's a lot of culpability with S&P, but also investors wanted to be blind.
And Michael Lewis is happy that people are rereading Liar's Poker
along
with
The
Big Short, which is his latest book, which is really where we get into all this stuff about the AAA rated securities and everything else. Anyway, thank you guys. Appreciate that very much. It's now back.